Hi, I'm Louisa Sijabat, a liquidator and bankruptcy trustee. Today's question is, insolvent trading, is it a genuine concern or is it just scaremongering talk from liquidators? So firstly, what is insolvent trading? That depends on what is insolvency. So insolvency is defined as when a company can't pay its debts when they become due and payable. So insolvent trading is when a director permits a company to trade or enter into transactions knowing that the company is already in that state of not being able to pay its debts when they become due and payable, or by entering into that transaction, it causes the company to enter into a state where it can no longer pay its debts as and when they become due and payable. So directors in the Corporations Act have a responsibility to not let their companies get to that state. So then the question is it a genuine concern or is it just scaremongering talk from liquidators? So now it is written into the Corporations Act. That does mean it needs to be taken seriously, like the other directors' duties. Are you likely to get sued for it if you do it? Now this is an interesting question, and this will depend on the liquidator and their view on if it's worth having any sort of legal action in relation to insolvent trading. So as the company gets bigger, the consequences of insolvent trading can get larger in terms of dollar value. So when you look as a liquidator and when you think that company became insolvent, you look then at the debts incurred after that date as potentially the debts that were caused or caused to be incurred or incurred during the period of the company's insolvency. And those debts added together would form the basis of a liquidator's claim for insolvent trading against a director, or sometimes they'll have an insurance policy, so hence claim against the director and or their insurer. So as the company gets bigger, any one particular day's trading could be quite significant in value. And this in particular relates to larger groups, larger corporations, maybe listed corporations, or just those with larger operations. In contrast, something which is a smaller business that might not incur that many debts between then and its point of liquidation, it might not be cost effective for the liquidator to consider any sort of insolvent trading claim. So especially if you're the director of a company of mid or larger size, the consequences can become more significant just because of the size of the company and its daily trading and what might be seen to be as incurred after when the company was insolvent. If you're in doubt, it's definitely worth looking into something called safe harbor, which is some sort of protection against an insolvent trading claim that may arise in the future if any restructuring doesn't work out. So yes, it's a real thing. The consequences and what might happen in a liquidation depend on the company's facts very much and what's happened to the point of liquidation, but also on the size, which liquidators sometimes called quantum, which is just a fancy word for size, of the debts incurred after, and the significance of if that could be worth pursuing or not. So it's definitely a very in-depth area, and that's just a bit of a summary of insolvent trading.